everyone, I am Tax Pro, and today is day 6 of our 90 Days to Taxes series. And what this series is I am helping new business owners who may not be organized, get ready for tax season, make sure that they're able to file with confidence, claiming those deductions and those credits. Day 6 is all about putting money into a business, taking money out. So how do you pay yourself? What does that look like? Tax implications of those actions, of putting money into the business, and making sure that we understand how that works. So this topic is dependent on how you're taxed as a business. It is different for each of the 4 types of business tax treatment for-profit businesses. And so this is the C Corporation specific video. I have videos that are specific to each of those 4 types of tax treatment. So sole proprietorships, S Corps, partnerships, and C Corps. This one is the C Corporation video. If you are not taxed as a C Corporation, go ahead and go back to the 90-day playlist, go to day 6 and find the video that is applicable to the way that you are taxed. And then if you are unsure of the way that you're taxed, if you go back to day 1, that will help you determine how you're taxed. So this is for C corporations, and I am just going to kind of dive right in. So C corporations are a different beast. If you own one, you probably know that. There's a couple of different ways that you can put money in, you can take money out, but the way that it is taxed is a lot different than these other businesses. So C corporations, if we remember, it's going to be very similar to Apple, Google, that kind of stuff. So when we talk about putting money in and taking money out, we have some really good examples with those large corporations. It's going to kind of trickle down the same way to these small corporations. So when it comes to putting money in, generally you're putting money into the business and you're purchasing stock of some sort. And so when you put money in, no taxable event, it's going to go into an equity account on the C corporation's side. You can write a check, you can send funds in via ACH. May be dependent though on the specific security requirements for your C corporation. So some C corporations, require reporting to certain authorities, and so there might be specific rounds of funding or something along those lines, and you need to follow the protocol for purchasing stock. So in that case, you wouldn't just send an ACH in to get stock to the C corporation. You would need to go through the individual that's handling all the security compliance, all that good stuff. So when you purchase stock, there is no impact on the actual business for taxes. For you personally, you're going to have basis in that stock. So if you ever go to sell that stock, that basis is going to be important because that's going to be what you paid for that particular stock. So just make sure you track that basis or you have some sort of documentation for that. When it comes to paying shareholders of a C corporation, there's kind of 2 main ways that we pay here. So one is going to be for work performed in the business, and we pay that via a W-2, right? So you're going to go on W-2, just like you can get a job with Google or Apple, and they pay you via a W-2. Work performed in a C corporation, you're going to go on payroll, and you'll get paid via a W-2. That's going to be taxed just like any other W-2. You're going to have FICA taxes withheld. You're going to pick that W-2 income up on your Form 1040. Okay? Now, in addition to payroll, when we have C corporations pay dividends, right? So dividends is payment of, from the income of the business. And so you may have dividends that are paid out. Dividends are taxed on the personal business owner level, so the shareholder level. So when you receive dividends from the C corporation, that C corporation has already paid income tax on that income. It's paid income tax on the corporate level, and then the dividends are issued from the income of the C corporation, right? And then those dividends go to the shareholders. And those shareholders then pay tax on those dividends on their personal tax return. The rate at which is dependent on that shareholder's, tax circumstances. So there's different capital gains tax rates and that kind of stuff. Keep in mind that C corporations, this is kind of where that double layer of taxation comes into play. C corporations have income tax. They are taxed on their income. So they pay tax at the corporate level. So that's one layer of taxation. Then from this income that's already been taxed, that C corporation issues dividends. And so the C corporation has tax, The shareholder then pays tax on those dividends. So we have 1 layer of taxation, 2 layers of taxation, okay? So there's double layer of taxation. What a lot of small C corporations will do in order to avoid that double layer of taxation is they will jack up the compensation on the W-2. Okay, the IRS knows this, they know that that's a thing. So when we are looking at C corporations, we need to make sure that we are paying a true W-2 wage, not a very inflated W-2 wage, in order to avoid paying tax on those dividends. Okay? The IRS knows that's a thing and they will take a look at it. And they can come in and they can reallocate some of those wages to dividends. That is something that they can do. Okay? So C corporations in general, you put money in, and that money is just essentially the basis that you have in that stock. And then for payment from C corporations, you have wages, and then you have dividends. When it comes to getting money to and from the business or the shareholders, you can also have loans to and from the C corporation between like the C corporation and the shareholder. So you can have C corporation loaning money to the shareholder or the shareholder loaning money to the C corporation. Okay, as long as it is a true loan with interest, it's being paid back, it's not being used for things like avoiding that double taxation. So for example, if the C corporation lends money to the shareholder and then that money just never gets paid back, and it's kind of an attempt to essentially get money out of the C corporation and not pay tax on those dividends, it's not going to hold up in an audit. Okay, so you can have loans to and from the business. You just need to make sure that it's truly a loan, it's getting paid back, it has interest assessed, all that good stuff. So that is how shareholders can put money into a C corporation, take money out of a C corporation. If you have any questions, let me know. If this video was helpful, please consider liking and subscribing, and I will see you guys for day 7.